tremendous dose of realism tinged with great optimism, as of course you should do. I'd like to now get our panel to join us here. I'm conscious we have a full program for the day, so we'll have a little shorter discussion than we had hoped. But please, if I may ask from the Dubai Mercantile Exchange, the Chief Executive Officer, to join us, Christopher Fix. Thank you. We're also very honored to be joined by India's former ambassador to Saudi Arabia, Oman, and the UAE, Mr. Talmiz Ahmad. Thank you, sir, so much. And the chairman of SecuraCapital Partners, Shri Culpepper. Shri, please join us here. Now, gentlemen, thank you so much. We'll have a swifter discussion than we might have anticipated, but tremendous information there. And I think we all learned a lot from that. But I'm going to move on, come back a little bit to one of the issues that was the panel voted on there a little while ago, the audience voted on, when they're looking at the situation in India, and we're looking at figures 250 million tons in terms of refined product out there that has to be shipped somewhere. And of course, the big audience now has been the Middle East. If I could bring you gentlemen in on this issue here. There is, and everybody felt in the audience too, that there's a lot of capacity been built up here in the Middle East. We've got 2 big refineries coming online in Saudi Arabia very soon, one later this year, next year, and again, Oman, Qatar, and also here in the UAE, looking very much at the downstream. The competition now, will indeed that export market be there for India? Who's going to take a look at that one? Perhaps I might address this to you, Talmiz, if I may, Mr. Ahmad. You've worked in this region for a long time, and you know the relations that are there and the demand that has been in place. In the event that that capacity is built up here, will India suffer because of that?
I don't think so. I think global demand is so substantial that there is no question of one side suffering at the expense of another. We are building up capacities primarily because of domestic requirements. And the domestic requirements are exponential in terms of their growth. I don't think when we were developing these domestic capacities, we were looking at the export market. Having said this, we should also take a look at our private sector. Reliance, for instance, focuses a lot on export. They buy heavy oil from Venezuela and monetize it in terms of product and make a huge sum of money. Also do recall that our public sector companies have huge social responsibilities at home, which has led to under-recoveries and substantial pressures upon their balance sheet. So as far as our public sector is concerned, it will be domestic use, expanding domestic use, supporting our own petrochemical sector and the fertilizer sector. And as far as the private sector is concerned, they will have a certain space and they will continue to look at export markets.
So it looks like neither of you are too concerned about what the International Energy Agency was projecting in terms of putting you up there maybe on a par with Singapore in terms of being a major player. For the most part, you really need to look at the growth in domestic consumption. Is that what you're saying?
I don't think we should compare India with Singapore. Singapore was an energy hub. Its entire life was based on exports. It had no other purpose. India is a continent and has a billion strong population, very different priorities, very different past and very different future. Singapore has its own pressures now because of other centers that have developed, particularly in Vietnam. But India and Singapore have very little in common in that regard.
Looking at the emergence of a new energy corridor, which there definitely is east of Suez, Chris, if I can come to you here, in terms of what's going on with the Dubai Mercantile Exchange. It's not just about India, and you've mentioned what's going on in Singapore. So where is that new corridor actually emerging? Where are the other players coming into it?
Well, we're seeing very strong growth in China, and His Excellency made some excellent points earlier when he talked about 50% of the Iraqi cargoes going east. We're seeing a very strong formation of the GCC to Shanghai corridor, and that demand picture has not slowed down. And for us, that consumer element has been very strong in driving the exchange. And I also think that the GCC itself is developing as a trading hub. When you think about these assets that are coming in and the storage and Fujairah and the pipelines and many of the other hard assets that are happening, it mirrors the growth in the region. If you look outside, and you see what's happening in Dubai, it's clearly strong, and the continued growth is going to A, provide a market for Indian petrochemical products, and B, also allow an inherent trading system or ecosystem itself to develop. So that's healthy, but also the strength and demand from India, where we were lucky enough to have Reliance join the DME, and also the continued drive from China. Those are the key factors that are going to push the formation of the corridor. And don't forget East Africa. I think that East Africa represents an excellent opportunity for refined products, because at the moment, I don't know if there's any refineries being built there, but there's a tremendous demand growth as well.
Jeffrey, if I can bring you in on this, when we look at the emergence of this new corridor, what implications does that have? When you look historically, it's been different. So in terms of international relations, what implications is that going to have?
Well, I think 10 years ago, the oil market was dominated by geopolitics. It had a lot to do with relationships between countries, had a lot to do with issues involving defense and issues involving who is going to dominate a political sphere, whether it be China in the east or the US in the west. I think that's changed dramatically. Right now, it is a consumer-driven market, and countries such as India and Singapore will service the market that's going to give them the biggest upside, whether it be domestically or whether it be within the region. No longer is North America and Northern Europe basically driving where energy prices are going. No longer are they driving where accessibility. With all of the increase in production in Western Canada, Venezuela, if you start looking at a lot of West African crude now, whether it be Angola or Nigeria, the market has really become much more efficient, and it's being driven by where is the consumer, who's going to pay the best price, and much, much less about the geopolitical considerations of who's ally today and who's going to be who's ally tomorrow.
And even though we're seeing a bit of a slowdown in emerging markets, or a bit of a stagnation perhaps at the moment, they'll certainly pick up again. That's really where the consumer will be in the longer term, and the growth will be there. Would you agree with that?
Absolutely. If you look at the growth trends, more and more the U.S. is going to be looking at Mexico, South America, and Canada, which means the dependence on Middle East oil is going to be less. That oil, I honestly believe, is going to be shifting east to be serving more efficient markets such as India and China. I think the West African and East African oil plays now are going to be more affected by internal growth. Because even with a slowdown in the emerging markets, the growth rates you see coming out of Africa are still the envy of most Western economies. So even a slow year in Central Africa is a win if you are a West African or East African producer. Because if you can ship your oil to the interior cheaper, then you can sell it in a very competitive market, say in China. You're going to service the markets that's closest to you and give you the best margins. And I still think that Africa is its own best friend right now.
Chris, I see you want to come in on that one.
Well, I was just thinking about what he said with regard to the U.S. becoming less dependent on Middle Eastern crude. This is going to shape the demand dynamics for the coming decade. And I think that one of the things that producers have to concern themselves is demand security. This is an issue of where you're going to place your barrels. And I think His Excellency was looking at that. And this is something that's going to continue to grow as these alternative production sources feed these established markets. And this is going to be what's going to shape this dynamic. India, of course, is extremely important because as that GDP rises and the middle class starts buying cars, you're going to have that demand story that we can't even see yet. But China, of course, is evidencing that by becoming the world's largest importer with 19 million cars a year. That's where I see the future of the corridor and the market going.
And you're looking at IEA figures estimating demand to be about 92 million barrels a day. Shale, as everybody felt, is going to make be a bit of a game changer on that, but still projections for next year, 8.5 million. So yes, they're getting up there, but when you look at long-term projections, will that be a big game changer for the rest of the world?
Well, let's talk about if peace breaks out in the Middle East. What if our friends in Iran start to become friends with the U.S. again? What happens if Iraq and you know, the issues that we see in Syria calm down? We're going to have a lot of oil on the market. And if I were a producer in the Middle East, I'd be concerned about where I'm going to sell it. Because unless people here, you know, basically in the GCC get out of the bus, and, get out of their Ferraris and take the bus, the demand story is going to be enormous in the region. So how are you going to have $100 oil support a growing lifestyle, which currently we're seeing develop in the GCC, and place your barrels when there's tremendous competition? I think the story is going to be about demand security, and this is one that the market needs to be reconciling.
Please go ahead. You want to come in here?
Whatever we say about energy, the opposite is also true. Whatever we are saying about the United States is highly speculative at this stage, and it is loaded with a lot of domestic politics. We are at a very early stage of something dramatic. It may go a certain way and it may not. Even if you look at the figures that have come from the United States, their import dependency, while reduced, is still substantial. They will still be importing about 37 to 40% of their requirements. They're going to be importing a lot of oil. They are already importing about 25% from the Gulf, and it's going to increase, it could increase. So there is a substantial dependence on the Gulf oil, and particularly on Saudi Arabia. So this is the first point with regard to the United States. With regard to the other countries, I think that China and India are going to be very important growth factors in the demand for global oil. I don't foresee a scenario over the next 10 years of a glut of oil. I think there is going to be a lot of demand from India. There is already 5% increase per annum in domestic demand for oil. And I think that's going to be, and I think China has even more than that. So let us be, I think I'm reasonably optimistic that there will be enough oil available to meet our needs, and the price will stay where it is roughly.
If I can come back, Mr. Butola, you talk about the situation on the depreciation of the rupee, and you're very optimistic about that, and you're not as worried as maybe some people out there in the general market are, saying we've been there before and there is an element of self-correction in there. But this is right now putting the country in jeopardy, really, in terms of the cost to the country, in terms of buying that oil. On the other side, I guess, in terms of your exports, it's good because there's tremendous demand there. But how long can you continue with such a low currency right now?
Can I also add to the previous question?
By all means, of course. Come back and we'll come back to that one.
I think, in my view, there is going to be a healthy relationship, which has been the case between the producers and the consumers, and both are going to take greater care of each other's interest. But one thing is certain, that the dynamics of the overall trade are going to see some changes. And with the shale oil or shale gas abundance in the United States, how much is that could be a question, etc. But we have seen, as practitioners of real business, the companies that we drive, we have seen that Canada, which is also largely supplying to the United States, now is looking towards Asia, and they have been talking to the various Asian companies to secure their supplies of oil and gas. And there is also talk of some of the ports coming up in the east coast of Canada, and that much more oil. So some dynamics, some changes will take place. That's the number one. The other part of the currency depreciation, and I have just tried to give the data in the past that there have been such periods, huge depreciation, and then followed with a little pain of 1 year or two, or maybe 1.5, 2 years. I gave it a medium term. The growth rates have really gone up in subsequent years, if you analyze all these depreciation years. But in terms of the countries, I would think, and Mr. Talmiz Ahmad and some of the persons who know about India, I think 100 billion net import, because $145 billion was the last year's import, and then approximately $50 billion was the export. So on net basis, the country imported about $100 billion of oil or oil products. If it would have been a worry, it was unthinkable when the oil was at $30, etc. And even small increase here and there used to make huge cry. If you look at the Indian media, if you look at the analysts' report coming here, nobody is talking about that. Whether the country has the ability to sustain that, people are talking that it's slowing down the growth rate, it's etc. In terms of the the larger the economy, it continues to be 6 to 7% of the GDP. So what we have to worry is, and the problems of India are not driven by other factors. We are forgetting the infrastructure bottleneck, the supply side constraints, the environmental clearances, etc. And in the law, the government of India has created a mechanism through the cabinet committee where investment worth $140 billion or $120 billion have been cleared, which will see implementation over the next few
But are you
years.
still seeing foreign investment coming into the country at the rate that it has been coming in over the last few years?
No, that has been
has
certainly a
slowed down
decline.
a
But
lot,
I would
yes.
agree. I would say there will be a
And
pain
how-
for some time.
How do you bring it back? Because there are issues within the country. There's issues in terms of the infrastructure bottleneck. There's also scarce capital, high funding costs, even issues of corruption and very basic issues that people need to deal with if they're going to invest in that country.
Yeah, I think we are living in very interesting times. Will these times continue? In India, all of debate around the corruption, some of the scandals which have been talked about, and the flight of the foreign or reduction of the foreign I don't think if there is a market, the market is in Asia. It's in India and China. And if the companies don't work on year-to-year basis, they work on a plan which is a medium-term, long-term plan, and they would worry about this market. So that's the point number one, that you can't ignore the market as you can't ignore the producing centers. You have to take your decisions right. And 1 year, I would say, there has been this also election year, and hopefully after this transition, we are going through crisis, some sanity will prevail. And people like us who tend to be on the side of little optimism would tend to think that the sheer awakening which has come in India and the aspiration of the people of India would force the people that be in power to take right decisions. That's my thought.
So Jeffrey, if the investors are not putting their money in India, where is that investor dollar going right now? Where is it looking to?
Well, it's interesting. There's quite a bit of money still going into alternative sources. But at the end of the day, dollar for dollar, the lowest cost producer in the world continues to be the GCC. They have the ability to reduce their profitability and still be very profitable. Where you look at the amount of money the Canadian government puts into the subsidy of the oil sands, environmentally, it's probably a very bad deal. The amount of energy it takes to extract the oil from the sands and what it does to the environment is very harmful. If the government was not funding that, it would not be competitive. So as a Middle East producer, they are still in a position that they can take advantage of the different trends in the market, who's growing this year and who's not. Countries like India will continue to take advantage of that. If you look at it, India is probably the best example of a democracy that works. The central government has very little ability to push buttons and pull levers. They can affect things around the edge. But at the end of the day, the Indian people decide on the direction that they're going to go in. And right now that direction is progress through prosperity. It's progress through a growing middle class. People want the choices of the kind of cars they buy, and they expect to be able to have the efficiency of the energy market. And that plays in the hand of the Middle East. Countries such as Iraq, who've gone through an incredibly painful history, are now coming out of that. And they're in a position to take advantage of this flexibility. We can ship our oil to the east, we can ship our oil to the west, and we'll still be one of the lowest cost producers. We're going to be much cheaper than the Canadians, and we're going to be much cheaper than fracking in the Midwest and the damage that the fracking could potentially cause. So I'm optimistic that the Middle East will still be in a position to prosper.
Let me bring Sean in here.
I just want to indulge and maybe get the last question of this session in, but I'd like to pick up on the point that Jeffrey made in his earlier point with you, Ambassador, and anybody else that wants to jump in, but the depoliticization of the energy markets, or where the demand is going, and particularly in the context of the subject of the session, and this new energy corridor, and what that means in the context of, let's say, Saudi Arabia-America relations versus Saudi Arabia, India, or China, or Gulf into the Asian corridor. I know you, in your career as a diplomat, were very actively involved in building those political relationships, and where do you see that point going in the future? Can the Fifth Fleet leave the Gulf and all will be well?
Politics and energy have never been separated, and I don't see any tendency at present in this regard. They are an integral part of each other. They feed off each other. There is never pure energy economics. There's invariably energy politics. And that is going to remain. It's going to be a realistic aspect of contemporary scenario for years and decades to come. I don't think anything has changed on the ground. What has changed is certain realities with regard to the energy corridor. Today, Asia is the principal consumer of Gulf production. It's between 60 to 70% of Gulf production is now consumed in Asia. China gets about 50 to 60%, India gets 80% if you include Iran and Iraq, GCC, Iran and Iraq, and China and Japan and Republic of Korea get almost all of it from this region. This is the new reality. Coupled with this, you have other realities that have emerged, and those are connectivities pertaining to trade and investment. So energy, trade, and investment have created a new Silk Route connectivity right across Asia. Now, this has had certain political implications. I don't imagine that in the next 10 years, the United States is going to pack up and go away. It has very important stakes in this region, and those stakes will endure. The stakes relate to the security of its allies, the countries of the GCC and Israel, concerns relating to the Iranian situation, and concerns relating to energy flows. All of these will remain. I think they're going to be with us for some time to come. There may be a certain new interest with regard to emerging China, and that is why certain minor changes may take place. One carrier may go here and there, but I don't think that's going to solve any issues for them. What we are looking at is, can we redo the entire strategic paradigm? That for far too long, for about 50 to 60 years, a single hegemonic power has dominated this region. And much of the instability and insecurity of the region emanates from the policies of this hegemonic power. Can we think fresh thoughts now with this crucial stake that Asian countries have in the security and stability of this region? For us, it is a matter of life and death, this region being secure. We have no other sources for our energy and for our trade and our investment. So I have a feeling that we are at the cusp of something new and something different. There are many challenges for us because the present environment militates against many of the things that I'm talking about, the medium term and the long term. The present environment is a short-term scenario. It could change. An engagement between Iran and the United States, for instance, a new realism with regard to reform in this region, in the GCC countries, which predates the Arab Spring and is an ongoing situation, a challenge for them. And you could see a new connectivity among Asian countries, China, Japan, Republic of Korea, and India, engaging with each other and defining over a period of time a role in this region, going beyond economics into politics and strategy.
If I can, Christopher, come in here, and I think I'm going to have to leave you the last word because I'm conscious we do have a rest of a program. How is this realism impacting the markets?
Well, let's talk about the market itself, and I will leave the diplomatic arena to the diplomats. But what we see emerging in the market is this connectivity, and it's happening on several levels. You do have, of course, the GCC growing its own ecosystem, but then you also have, China, which I spend a lot of time in, really engaging in terms of being the major consumer and also wanting a stake. That's talking about where they're going to price their energy from. That's talking about decoupling from the existing structures that are happening in the US and in Europe and creating something that's unique to the ecosystem that we're all a part of. And India is a huge part of it, as well as, of course, the producers. And what we're seeing now is a demand for things like Shanghai futures trying to price their own oil, for other, pushes from the consumers to have a say, a greater say, in how the market structure evolves. And this interconnectivity, which the ambassador alluded to, is what we're seeing. Of course, I'm seeing it on the market front, but why is there a push for refining assets and storage assets? It's because the market is looking for it, is calling for it. And that interconnectivity of our own market east of Suez is what is the dominant theme that we're witnessing transforming in our particular region.
Now, I am very conscious that we do have a full program. We're going to have to wrap this up, and it breaks my heart to finish it because it's almost like we're just getting in there. It's obviously a topic for another discussion we're going to have to start up. Gentlemen, I have to thank you. I'm sorry, we've got a busy program for the rest of the day, and thank you so much for your input. We will have more time to discuss this individually. You will stay with us. So, gentlemen, once again, Jeffrey Culpepper, thank you so much. Ambassador Talmiz, Ahmad, once again, thank you. Christopher Fix, thank you so much. And to Shri Butola, thank you so much for your insight in that.